That's true. I have another thing that I want
Yep.
to ask you.
Yep.
What is the drawback of the tax deferral strategies?
That's a great question, actually. So, tax
Thank you.
deferral is like it sounds, it's a deferment. So, the most common one is a retirement plan, right? Whether it's 401k or an IRA or whatever. So, you put money into a special account this year, and your taxable income goes down by that amount, which is fine. Okay. The flip side is that because you got a deduction this year, in the future, when you access that money, you have to pay taxes then. On the surface of it, that sounds fair, right? Break over here, I got to pay over there. It comes out even, but you get the break now, which is more important than later. And so that all works out. The difficulty comes in a couple ways. So one is that you've put strings on your money. So if you need to access that money, then you get penalized. So I've seen many cases where people put money into a 401k, for example, and then they decide I need that money for whatever reason. Some reasons are good, some of them are bad. I've seen both for sure. So reasons I would consider good would be, hey, my kid's going to college, or lost a job and I just need money, or medical emergency and I don't have money to pay for it. Those I think are all reasonable. The bad reasons that I've heard from clients in the past is I wanted to redo my kitchen, or I wanted to go on vacation, or I wanted to pay off my house, which just blew my mind. Because why would you take 40% tax money and pay off a loan that you're paying 4 or 5% interest on? That makes no sense. But it was done. And yeah, so there's good reasons, bad reasons to do it. But whatever the reason, if you take the money out, one, you're probably taking out a big chunk. So your marginal rate is going to go up. So if you were in the 24% bracket the year you put the money in, and then you take out the money and you've increased your income so that now you're at the 32% bracket, you're already behind. And then on top of that, you're going to have a penalty if you're younger than 59 and a half, which most people doing this are. So now you have whatever your marginal tax bracket is plus 10% on top of that. So it becomes very expensive to access that money. Now there are strategies to deal with that. In some programs you can take loans, like 50 grand or something like that. But the it's going to be each plan has its own rules. Some of them allow for hardship loans, some of them don't. Some of them will do this, and some of them will do that. So it just depends on, again, case by case basis. So that's downside number one and two. Downside number three is that fundamentally we don't know the future. So the if you talk to financial planners and you talk about these retirement accounts, the pitch is usually the same. It says, yes, you are going to have income that you have to take in the future, but you're going to need less income because your expenses are going to be lower. When you're talking about the kids are out of the house and blah blah blah. And sometimes that's true. A lot of times it is not. So one, we have to deal with the effects of inflation because we're talking about if you're 45 and you're talking about pulling the money at 65, that's 20 years. So the numbers that you're talking about now have nothing to do with the numbers in 20 years because of inflation. So cost of living is going to change, the tax brackets are going to change, the tax rates will definitely change because Congress will pass some law sometime between now and 20 years from now that changes how things are taxed. I can virtually guarantee that. And you're trading a known cost today for an unknown cost in the future. Now, sometimes it works out, sometimes it doesn't. It all depends on what assumptions you build into the model. It's not as clear and easy as a lot of the promoters of retirement plans will put into it. Now, there are other kinds of deferrals, like a deferred sales trust, where let's say you sell a business and you don't want to take the tax hit all at once. And so you put it into a special trust that doles out the money over time. That has its place. That does not have quite the same strings as like the retirement account money does. The trade-off you're making there is you're taking income over time rather than all at once. And depending on your financial situation, that may or may not make sense. Most people want their money now. I can tell you that from experience. Even though the tax rate is higher, most people end up going that way anyways. So that's another, not necessarily downside, but it's a trade-off. So that's always that's always the case. It's always a matter of trade-offs. You're exchanging this thing for that thing. So with retirement accounts, known impact for unknown impact, free use versus a lot of rules for that money. So those are the kind of two basic ones. And by far, that's going to be the biggest issue when it comes to deferral.